Welcome to Property Developers Question Time. This is your opportunity to learn about the property development business. With me are a panel of experienced developers, and through your questions you'll gain an insight into the world of property development. My name's Stephen Galpin, and with me today are Mike Frisby, owner of Galpin Developments.
Hello.
Welcome. Evan Maindonald, founder and CEO of Melt Homes.
Thank you.
Welcome. And Rob Wilkinson, founder director of Crowd with Us, London-based crowdfunding operation.
Thank you, Stephen.
But Evan, I'm just going to come to you first. Thank you very much for your invitation down here to Hythe. We're filming today in your new 162 development, which is a marvellous mix of contemporary and modern design, using local materials. Tell us a little bit how you first got the site.
So we bought the site with an existing consent for a new build of 5 flats, and one of the things that we always do when we buy development sites is we look to enhance the value of those sites before we start development. And so we worked with Guy Holloway, who's a leading contemporary architect, actually based in Hythe. He also has an office in London, but he has a very strong reputation for delivering innovative modern style designs which nonetheless fit in well with their surroundings. We worked with him to come up with a design that we liked and that would fit in with the local architecture. So we ended up with 6 flats instead of the 5. We also built an outside space to all of the flats, so all of the flats have a balcony. The top floor flat has 3 in fact. But what we've ended up with is a building that is contemporary, but it has traditional aspects to it, like the ragstone on the ground floor. It's got some interesting brick corbelling on the outside, but that's combined with modern features like frameless glass balconies, a zinc roof. And so if you look at the building from the front and you see how it fits into the streetscape, it actually adjoins a listed building.
I did notice this morning. Yeah. I think you've done a wonderful job with that.
Thank you.
It does blend in extremely well. It's a lovely little town. I haven't been here before, but I can see exactly why you've
Well,
perhaps
you'd like to buy a flat here and retire. Well, not ready yet.
If only I could afford it. I think you guys are all on a different pay grade to me, so there we are. Now look, our subject today, we're going to be talking about property crowdfunding, and that's from, first of all, the choice of development site right through to how the development gets funded and its eventual disposal. So the first question that we've been presented with are, what are our options for finding investment property development projects? Mike, I'm going to come to you on that first.
Yes, so there are many different ways that you can actually help fund your investment. Obviously, most people do get what is known as a first charge lender who does the bulk of the lending, but it's the next slice that often the developer is out there looking for further funding. You know, initially you're probably getting going with your funds, but to do multiple developments, you often run out of your own funds, so you look to other people to get funding. And that can come from many sources. One of the new sources is obviously crowdfunding, which we're talking a bit about today. But, you know, wealthy individuals get involved. You've got other specialist lenders who will also get involved. And there's many different ways that they can get involved as well, because sometimes they take part ownership of the development, so equity funding. Or it will just be a loan note to the actual development. So there's many, many different options out there.
Okay, fine. Evan, you've experienced this crowdfunding. I think with this development, have you not? Was it a smooth passage?
So this was the first development that we ever crowdfunded equity on. We raised £200,000 of equity. We did that in November 2017, and it was for us a test of whether that was a way in which we could raise equity for our property development projects. It proved that we could, but actually we raised, it took us a lot longer to raise the money than we thought it would. We thought it would take maybe a week or 2. It actually took us 7 weeks. We actually raised 80% of the money from people we knew already. And so in fact, we then went back to the drawing board and said, okay, that didn't work as well or as quickly as we would have liked, because our aspiration was to be able to raise millions of pounds and to be able to raise it quite quickly. We worked out how we could go about crowdfunding those larger amounts of money, and during the course of last year we did 2 further crowdfunds. One raised very quickly. We raised £130,000 in 18 hours. In fact, using Crowd with Us, the platform that Rob is a director of and works for. And then we did a further raise in November last year of 1.13 million, and we raised that in about 3 weeks. So you need to work out how to do equity crowdfunding. It isn't necessarily as simple as just putting an offer out there and thinking investors will take that up. And the question of how you work out how to do it is actually quite complex. And so I won't go into too much more detail about that right now. I think it can come out in the rest of this episode, but it's something that we've learned how to do.
Okay. I mean, one question I'm going to ask you rather than our crowdfunding expert here is there a level of impatience from the crowdfunders? I mean, development is notoriously a slow business sometimes. You get setbacks, you get planning changes, difficulties perhaps. I think with this building, I mean, I think you said it was grade 2 listed building.
Well, the one adjoining it's listed, yeah.
Okay. Yeah. So there are complications in development which do slow things up. And I wondered, as a developer, what your perception was of the tolerance of the crowdfunders.
Now, this is interesting. So when we're raising money through a platform like Crowd With Us, we're raising money from individual investors. And so the crowdfunding platform facilitate that by providing a FCA regulated wrapper for us to do that, but also by introducing us to investors. And so, but in essence what you end up with is you end up with a number of individual investors in your project, and some of those investors don't know a lot about development necessarily, and they may not be as understanding when it comes to some of the sorts of problems that developers experience as a development lender who specialises in it and does it all day would be. So you do have to bear in mind that you're dealing with individuals who maybe don't want or aren't interested in understanding the complexities and the problems that developers run into. But that, I think if someone's investing in a crowd-funded property development project, it's important that they are aware that it isn't a guaranteed return and that there are complexities that will come up, that there may be problems that could come up that could, for example, delay the project or could have an impact on the return they might get out of the project. Those things are, I think, a sense in which investors are starting to learn to understand how this kind of crowdfunding works.
And as I say, that's something where the platform actually comes in, because they're the intermediary between the developer and the investors. So they're monitoring the project on the way through, and they're keeping the investors.
So it's down to your packaging really at the beginning, isn't it?
We're giving the right information, doing the adequate due diligence, but then keeping everyone up to date and making sure that the investors are aware of what's happening and the progress of the project.
Okay. But I want to come back to the point. This is quite important. For me, it's really important that investors understand exactly what they're getting into, because the last thing I want in one of my projects is a nervous investor. A nervous investor will be asking questions all the time, and it will be difficult to deal with. I want people to be completely comfortable with what they're investing in and understand it fully, because otherwise I just end up in a situation where we're dealing with investors' queries all the time because they're not comfortable with what they've got into.
Yes. I mean, I do think customers' sort of confidence and understanding of the project is very important. I mean, I think we've all gone through the stages where our banks have become nervous over the last 10 years of investing. There's been a lot of bank syndication, which is just really bad news. You know, when you're a developer, you've got 4 or 5 banks to deal with. They all take a different view on what should or shouldn't be happening, and it can turn into a nightmare. So this is an interesting progression, a new way of investing. And I think the natural question is, how risky is it for somebody who is investing in crowdfunding?
Well, I think as with any investment, there's an element of risk. I think that it's down to due diligence. I mean, any investment, it's all to do with due diligence, but that's from the perspective of the investor. So the platform that they're going to work with. So go out there and do your research. Obviously, crowdfunding is regulated. So what's the track record of the platforms? Once you're comfortable with the platform, what level of due diligence are they doing on the actual projects? We've already talked about communication. How well informed are they? What's the experience of the developer? What type of paperwork is there up-to-date valuations? Are all the numbers being quantified and qualified? And what securities are in place. So it's about, there's inherent risks, but it's about mitigating those risks and building a relationship with the people you've been giving your money to.
Okay, so in terms of protection, people are protected by regulation, and you as a crowdfunder are obviously regulated. How far does that regulation go in terms of the information that you give out? I mean, one thing that just slightly worried me there, that you were saying, well, you know, it's up to these people to go and do their due diligence. I think typically a small crowdfunding investor will perhaps not even know what due diligence means.
But I mean,
and I'm just wondering to what extent.
Having been through the mill, there are two levels of due diligence. I think there's the due diligence that the platform does.
Yes.
And having been through the mill with Crowd with us a number of times, they do the same sort of due diligence that a lender would do before lending on a project. In fact, it's even tighter, I suppose, because you're dealing with investors' money. It's not just a loan. You know, a senior lender might be more comfortable because they've got a first charge. There's a second level of due diligence which happens once the crowdfunding platform presents that to the investors, and then normally most investors will want to have a conversation with the developer, or at least understand something about the background and the track record of the person who's behind the company. Right. And that's one reason why profile is important as a developer. People need to know who you are and what you've done and what your track record is, and before they'll invest in you. And I would have thought, Mike, you know, you work with investors.
Yeah.
That's something that would be bread and butter to you.
Yes, absolutely. I think it's a good innovation for the marketplace. And I think if I put my investor hat on, one of the advantages is actually you can invest in many developments. So you can put a little bit of money in lots of different things, which de-risks, spreads the risk. And I think actually that is one of the ways to de-risk your investment, because otherwise you might have all your sum, you meet one person and you're putting it all with one person. Yeah. So the element of putting a little bit with lots of people is a way of actually getting a certain amount of de-risk as an investor. And also the platform allows a developer like me to take in lots of smaller pieces of money, where previously I probably wouldn't have been able to cope to do that. I'd just want a few or one large investor.
But with your investor's hat on, my point was that you're not going to just jump in and invest in the first platform. You're going to shop around, aren't you, and make sure they've got the same values. I guess you're going to get you're going to look at the platforms themselves, because as Evan was saying, they're doing different due diligence on. I guess there's different levels of due diligence for each platform. They'll have different rules and regulations, and also on the developer. So there's two layers. I think that's what Rob was meaning, of the platform itself and then the developer themselves. But I think this is the thing about crowdfunding. Everything becomes far more visible. And you know, again, the investor kind of needs to know who you are, and therefore the visibility of a developer is
hey, gentlemen, critical. We'll have to leave it there. We're going to go to a commercial break now. Join us after the break. See you in a moment. Welcome back to Property Developers Question Time. Now, I think, Rob, this is a question for you. We hear lots of technical expressions when we learn about lending and crowdfunding and all sorts of other types of funding operations. Some of the popular phrases are peer-to-peer lending, property bonds. Can you explain the difference?
Yes, I certainly can. So peer-to-peer is where an individual can lend money through a third-party platform to other individuals or businesses. That'll be in the form of a loan, and a bond is very similar. So I think that's also a debt instrument. So the two main really are debt and equity with regards to property development. So the fundamental differences between debt and equity. So debt debt would be a fixed return for a set period. So 12% per annum for 12 months, and the developer's tied into that. So if he doesn't pay back the loan within the 12 months, and there will be consequences. So there'll be a penalty clause, or you can recall the debt. And also, a bond or a debt is generally securitized. So there'll be a charge on the property, maybe a debenture at land registry, a personal guarantee from the developer. And with regards to equity, equity is where the investors become shareholders in the SPV in the company, and they'll be offered a profit share. the developer doesn't necessarily have to give as much security away. And the difference is the return is going to be projected, as is the time frame. So if it's a 12-month project, but it's a 12-month projected project as equity, if it does run over, there's not as much freedom for the investors to get their money back.
Yeah. So I mean, and I think it's worth coming in on that from an investor's point of view. Equity is more risky, but potentially offers higher returns. Debt is less risky because it's secured, but it generally offers lower returns, and that's the trade-off between the two. Interestingly, what most investors seem to be interested in is the higher return stuff. That's just the perception that I have. But also I think there's another angle on this from a developer's point of view. I don't see a lot of point in crowdfunding debt because, at least not debt for property development projects, because there are many development lenders out there who will lend on development projects at much more competitive rates than people are prepared to put their money into an investment for. So from a developer's perspective, the only form of finance that I see any point in crowdfunding is equity. Now, for me, equity changes the game in terms of, or crowdfunding changes the game for equity. The historical way of raising equity for property development projects was that you would work with either high net worth individuals or private equity funds or family offices, and you would end up in a situation where you would either take the terms that investor offered to you or you wouldn't. And so it put the investor in quite a strong position in terms of dictating terms to developers. With crowdfunding, what a developer is able to do is to put an offer together, offer that to investors, and investors can decide whether or not they want to invest in that offer. And so it means that developers can decide the terms on which they wish to offer investment in their projects. But it also works well for investors because smaller investors would not otherwise get access to the returns offered by large-scale property development projects. So in that sense, it's a win-win for investors and developers. And as Mike said earlier on, I think this strategy of diversification across different developers and different projects is something that is important. I think that's a basic for any investment strategy. You don't want to put all your eggs in one basket. And so what I see a lot with my equity raises is I see the same investors coming into all of my raises with smallish amounts of money, between £1,000 and £5,000. And so they consistently invest in all my projects. I'm very comfortable with that because I know that those investors are not deploying all of their resources into a single project, and so they've got a spread of risk across different projects. That makes them more comfortable.
So I guess the other thing that crowdfunding is doing is opening up to the masses, to everybody, the ability to invest in developments that was down to, essentially open just to high net worths or family offices or institutions.
The barrier to entry.
And now it's opened up to the more of the general public.
It's democratising
finance,
and it's democratising the returns that were only previously available to above a certain level of wealth.
Having removed that barrier of levels, you both mentioned security. So is it a case that the platform takes overall security over the property that's being developed, or how does that work?
It depends from platform to platform, so I can only talk about Crowd with us, but we CW Trustee is a separate company but to Crowd with us, but we're the trustee on the securities. So we have a lawyer that sits on our side, and although the money's all raised, we won't hand the money over until our lawyers confirm that all the securities or undertakings are in place.
So although the investment has been diluted through many people, the security is just as strong.
But it does depend whether it's debt or equity. So with equity, what normally happens is the investors take shares, usually non-voting shares, and usually preference shares, and their preference in the sense that they get their money out before the developer does. They take those shares in the SPV, the special purpose vehicle, that's actually doing the development. So the company that owns this building is called Melt Hythe Limited, and we have a number of investors that own shares in Melt Hythe Limited. The way it works is that the investors buy those shares off us when they put their money in. At the end of the project, we buy the shares back at an increased price, at a premium, effectively, which depends on the profit that we make on the development.
But I think it's important for people to understand that the different platforms kind of operate in different ways, and that it's important to understand what your investment is, so that if you go to one platform, they might operate in a certain way. So, there are funders out there who literally just deal with debt, and then there's others who concentrate just on equity and others that do both. So it's really important, and I think Evan touched on this earlier on, for an investor to really understand, is it debt or equity that you're getting involved in, and therefore is my return fixed or variable? Because I can see, sometimes I see these nice returns coming through, but I don't think the investor is always totally aware that it is a variable return and it's an expected return, it's a development. It could be even better, but it could be worse, that if we get tough times, that therefore the return could be a lot less or nothing.
I do think that investors don't often enough ask the question, what is my security here? You know, there's a big difference between a first charge and a second charge. There's a big difference between a second charge and equity. And the first two are secured over the property. Equity is not secured. You're a shareholder, and you're fundamentally in the same position as the developer is in terms of risk.
And I think there's a big thing here with regards to working with experienced developers as well, because although you may have an equity project that doesn't necessarily have the same securities as raising debt, you can mitigate certain risks by cost overrun penalties, time overrun penalties, and making sure that what contracts are in place.
Yes, I suppose one of the most obvious questions is for a small investor, he puts his money in, he comes to you as a platform to do this, you in turn do your deal with our two colleagues on your right there. How easy would it be for an investor to come out? Is there a secondary market for these shares, or these part shares or part equity?
Again, some platforms do have a secondary market, some don't. I think the most important thing, again, is working with experienced developers. So as part of the due diligence, what is the exit for the project? What's the plan A? Is it sales? And how buoyant is the sales market? If it's not sales, can he refinance? Does he have enough of his own capital to buy the investors out? So it's looking at the exit, but right at the beginning.
Well, I think there's also a developer's perspective on that. If you are wanting to continue crowdfunding for your projects, you need to make sure that the investors that you have in your projects have a good experience. And so there's a very strong incentive for the developer to do everything that they can to get investors out with a good level of return as early as possible, because those people who have had a good experience will come back and invest in another project.
And it becomes very visible. I think one of the key things about the whole crowd is it becomes very visible very quickly. So if a developer isn't performing, the crowd platform will know very quickly, but the investors will know very quickly as well. And that reputation, which as a developer you want to keep, squeaky clean, is so you will do what you can. And I think that's one of the benefits to an investor, is that you're utilising the knowledge of the platform, and also it comes out very quickly. So you certainly won't get further ones funded through that. Whereas I guess if it was all, previously funding was often behind closed doors, so no one quite knew what was going on and what does go on. Yeah. So you could keep going as a developer that potentially wasn't doing that well, because you'd be going into different dark corridors and no one would know what happened in the other dark.
During the last recession, the general population lost so much faith in the banking system that, crowdfunding is relatively new, but the reason it's taken off is because they've got a say over what their money's doing, where it's going, and they can actually see it.
Okay, so the final question on this, I think, has to be, where do you see crowdfunding going? Is it replacing the banks? Is it replacing the institutions as a serious development funder? I personally, I think there's always going to be a place for banks, but I think that they're going to work a lot closer together with, and same with the institutions, and work a lot closer together with crowdfunding platforms. And in fact, a number of banks have invested in crowdfunding platforms. Yeah,
look, I think we're going to see hybrid structures. So we are in the process of assembling a deal at the moment, which will be a joint venture with a private equity fund, but we're going to crowdfund money into that deal. So the private equity fund will stand behind it. They'll put up to £5-6 million into it if we need it. But actually what we've agreed is that we will have an opportunity, or an option it will be, to crowdfund about £4.5 million of equity for the project. And that will improve the terms that we get on the deal. So that's an interesting structure. I don't think it's certainly something that I've never heard anyone else having done in the UK before. So I think we will pull that off. And if we manage to pull that together, it'll be an interesting blend of private equity and crowdfunding. So I think we will see evolutions in different ways of structuring equity and property development projects that come about as a result of the new crowdfunding platforms that are now growing.
Okay, gentlemen, thank you very much indeed. Mike Frisby, thank you. Evan Maindonald, thank you. And Rob Wilkinson, thank you very much. Thank you again, Evan, for hosting us here today in Hythe. Thank you very much. Join us next time on Property Developers Question Time.